When a stock's price starts crashing, most beginners feel pure panic. They either sell everything at the bottom or blindly buy, hoping for a quick bounce. But experienced traders know that a crashing market leaves specific footprints. They wait patiently for a visual signal that the bleeding has finally stopped. Think of a hiker stepping onto a frozen lake. First, the hiker stomps down hard to see if the ice cracks. If it holds, they take a second, lighter step to make absolutely sure it's safe before walking across. Markets do the same thing. The first violent stomp is the atom pattern, a sharp, narrow V driven by panic selling. Next, the market takes a lighter step. This Eve pattern forms a wide, gentle, rounded U-shape right beside it. That first V-shape shows us the final capitulation of terrified sellers throwing in the towel. The rounded U-shape that follows shows the market cautiously double-checking its footing. Buyers are stepping in slowly, testing the ice to make sure the panic is truly exhausted. Recognizing this sequence, a sharp plunge followed by a rounded test, gives you a massive advantage. Instead of trying to catch a falling knife while everyone else is panicking, you can clearly see the market building a stable floor. To know if that floor is actually stable, we have to look beneath the price line. We need to check the trading volume, which acts as a lie detector for the entire pattern. This chart shows a real-world example of the pattern. On the left side, the price drops sharply into that narrow V-shape we expect from an atom bottom. If you look directly beneath that spike, you see very tall, dense volume bars. Volume is simply the total number of shares traded during a specific time period. These massive vertical bars confirm that a wave of sheer panic selling hit the market all at once. A few weeks later, the price dips again to test that same level. But notice the shape here. It forms a wide, rounded bowl. This is our Eve bottom. Now check the volume beneath Eve. The bars are noticeably shorter and receding. The frantic selling has completely burned out. There is almost no panic left in the system. This combination is exactly what you want to see. High volume during the panic, followed by low volume during the retest, gives you visual proof that sellers are exhausted and a sturdy floor is in place. Spotting a V and a U next to each other isn't enough to risk your money. A valid pattern requires a significant recovery hill between the two dips. Between the atom and Eve bottoms, the price naturally bounces upward, forming a central peak before dropping again for the Eve test. For this setup to be considered a tradable pattern, the price must rise at least 10% from the lowest valley floor to the top of that middle peak. This 10% rule acts as a strict mathematical filter. It proves the market has enough inherent buying strength to overcome the heavy downward momentum that caused the crash in the first place. Even with a perfect shape and a 10% hill, buying right at the bottom of the Eve curve is a trap. If you buy before the pattern officially completes, 64% of these setups will fail, and the price will just continue to crash. To avoid that trap, we draw a horizontal confirmation line straight across the highest high between the two bottoms. The setup is only triggered when the price closes decisively above this line. That breakout verifies the trend has reversed. Let's review the checklist. We need a sharp, high-volume atom drop. We need a rounded, low-volume Eve test. We need a central hill at least 10% tall. And finally, we need a clean breakout above the confirmation line. By holding your ground and waiting for that final breakout, you eliminate the dangerous guesswork of trying to pick the exact bottom. Instead, you enter the trade backed by the proven upward momentum of the market.